Hello and welcome to Switzer Investing TV. Thanks for joining us. I'm Peter Switzer. And tonight's program, I've got Jun Bei Liu from Tribeca Alpha Plus talking about her outlook for investing for the next 12 months. Might surprise you, well, probably wouldn't surprise you, that I'm pretty positive about stocks for the next 12 months. But I do want to get reinforcement from others, people who might see the market slightly differently to me. And so we'll ask Jun Bei Liu about that. And we'll also ask her about a few companies that I'm interested in, like Linus, for example. That's one company I'm keen to talk about. Companies like Pilgrim Minerals, PLS, and also some companies in the novated lease space. There's a bit of a good reason to think about these companies. So we'll talk to Jun Bei Liu about that. And then ST Wong, the fund manager from Prime Value in Melbourne, he looks at the companies that he thinks look really ignored or rejected by the market, but could be nice rebounders over the next year or two. And they're quality names. That's the part about what I think he's going to talk about you'll be interested in. So that's the show. Let's now kick off with Jun Bei Liu of Tribeca Alpha Plus. Jun Bei Liu, thanks for joining us.
Thank you for having me, Peter. I always love to talk about markets.
Yeah. What's your feeling now about investing for the next 12 months? Is it going to be onward and upward?
Look, it certainly feels a little bit like that, because if you actually look at the underlying data, whether economic data or corporate earnings, things haven't been too bad. This is the same case for the US as well. Remember, US started raising their interest rate much higher than us, and much earlier on than us. And the economy is actually holding up not too badly, and their consumer sector is still doing well. And certainly look like the US is heading towards a sort of more of a soft landing than the recession that everyone predicted earlier on. So, for Australia, certainly at the moment where inflation is falling quite quickly, and that, perhaps is going to follow the US path. And our economy, of course, it's only just started to slow down. And this reporting season is going to have a bit more downgrade for 2024. But net, it certainly seems like we're heading the right path. As long as the RBA doesn't put up the rates too much.
Yeah, that's going to be an important one. So, yeah, when your guys started looking at that inflation number, I know my first inclination was to take the 0.8%, multiply by 4, and annualize at 3.2. And I know Shane Oliver took the core number, which was 0.9, and it was probably the best one to use, and annualize that, it's 3.6. It does look like inflation, as we're feeling it over the past 3 to 6 months, is getting lower, and it's believable that the Reserve Bank's done enough.
Absolutely, I think it's very low. And what's interesting is that despite all the people talking about the wage inflation and everything else might be a bit more sticky, it is still falling quite quickly. Same as the US, all the inflation data has fallen much faster than expected. That's why the rate increase is pretty much done in the US, and they're talking about pause for a long period of time now. Here in Australia, tomorrow obviously it's a big decision. Economists are talking about 50-50 split of whether they will increase rates. I think they will pause, and I think they should pause, just given the rates, whichever way you just slice and dice it, it's falling into that more comfortable zone. And and then this corporate earning will see a bit more, of some of the weakness that is already being felt in the economy.
Yeah, let's go to some of the stocks that you and I have been talking about, and a lot of people have been contacting me, asking me about Linus. What's your feeling about Linus?
Linus is looking very incredible value at the moment. Today, it had a really good result. Now, the share was sold off on the basis, well, actually, it was a few months ago on the basis that, one is obviously the, China recovery is a little bit slower than expected. And two is that there's a bit of uncertainty about how long they can produce in the Malaysian government, in Malaysia. And clearly more about a few weeks ago, they had a positive announcement out of Malaysia. They're able to extend their license license to produce a little bit longer. And that really put the company in a very good position. And now its own existing mine here out of Australia is going to come back online and put this company in a very good position. I think just think about this company as a very strategic asset. Rare earth outside China is very, very valuable, particularly for a future where, you know, there'll be more separation between the US and the China in terms of economy as well as strategic alliances. So, you know, deposits of a rare earth that's outside China is going to be highly sought after, and it's very well run, good management team. I think it's looking very good value.
Okay, let's go to another one. PLS, Pilbara Minerals. What's your feeling about lithium generally and this company specifically?
Sure. So in terms of lithium generally, well, I think it looks very attractive. Share price recently has had a bit of pullback, which is a great entry point for you know, investors to really get exposure to that long-term demand for that lithium battery space. You know, lithium mine is difficult to for the mine to come online to actually generate cash flow will take time, and PLS is one of the first one that moved into those space and now in production, and now it's generating billions of dollars really in cash flow out of the current high spot price for lithium. You know, within China, which has been a big driver for electric vehicle and hence the demand for lithium battery, you know, there's a lot more increasingly there's more incentive into that space again, and not just China, that's globally the target for EV as well as cut to emission is all very, very promising for this space. So, you know, you absolutely have a lithium stock in your portfolio. PLS is the best position, and it is it's much one of the only pure play they can have in this space.
Have you looked at the drive for alternative technologies that could undermine the potential of lithium's commodity price?
Look, absolutely. There's a lot of technology, oh, not a lot of, there's a few technology has been in the pipeline for actually, you know, decades. The only promising one at the moment is the saline battery. So essentially it's using saline, the salt water. And in the China Motor Show, Shanghai Motor Show a few months back, it's being, you know, talked about. But the challenge with that type of battery at the moment is that, you know, there's no high intensity. It's really for the lower power vehicle that can potentially use that type of battery. Cost is very low, but you know, in the next few years that will go to the lower end. However, for the high end, you know, bigger, larger power sort of battery, you know, there's really not much alternative yet. And I'm sure in the future there will be more technology coming online. But this company is trading on literally a few multiples, a very low multiple on the cash flow they're currently generating, with billions of dollars in cash just sitting on the balance sheet. So hopefully by then, this company pretty much will be a cash box. And then perhaps they will be one of the first to invest in a lot of those technologies.
Okay. And you said to me, you like to talk about novated lease players. How many are there?
Well, there's a few of them. So there's SG Fleet, there's a Smart Group, there's MMS, and I think there's one more. And so these are the sort of, you know, that whole space. Novated lease is interesting because that's probably what you're thinking. You know, it's been running for a long time, this industry. It has had its challenges, had really good times a few years back, and then they had all the regulatory changes, and the last couple of years has been tough for them as well. But what's really changing at the moment in the last 12 months, actually since November last year, government has changed a policy. Now, what they have done is that, again, coming back to the electric vehicle, because of the, you know, how government is committed to get to net zero and the like, we are going to, the government has now removed the fringe benefit tax for lower end entry level electric vehicle. So so essentially it make a $80,000 electric vehicle to cost the same as something like $50,000 as a normal vehicle would cost through the novated leasing space. So incredibly, it has made electric vehicle in that price point incredibly interesting, and it sort of just reignited a lot of excitement back into that novated leasing space. Electric vehicle was something like 5-6% of the overall leasing through novated lease. Within 3 months, it became 20%. And what we heard in the last month or so, it's now become 40% of the volume. So, and the volume uplift is significant. Now, none of these, because it just happened so quickly in the last 6 months, none of those companies has yet reported. So they have talked to some of the fast big numbers. But if we put through the current trajectory in, even just take Smart Group, for example, by December, it's a December year-end company. By December, the earning needs to be upgraded by 20 to 30%. This is very, very significant and meaningful change to this sector, and it's a multi-year sort of growth, a tailwind for this entire sector. So absolutely investors should have a look at this space.
So what's the one you prefer amongst the
I will go for
team?
the pure play.
Smart Group.
The Smart Group, yes.
Okay, all right. Well, a nice piece of homework for us to look into. Thanks for joining us, Jun Bei Liu. See you in a couple of weeks' time.
All right, thank you so much. Thank you for having me.
Well, joining me now is ST Wong of Prime Value, a fund manager. I'm interested to kick off by asking him, what's his outlook for investing for the next 12 months? ST, great to see you.
Well, great, Pete. It's been a challenging last 12 months, but markets are still up, which is a great positive. What does the next 12 months look like? Look, potentially the consensus, and I'll tell you what consensus is looking at, probably a choppy next 6 months, and perhaps a better second half of financial year 2024, which I probably don't disagree with. But if we think back 6 months back, when the market was thinking zig, investors were looking at zag. So whatever predictions that anyone had proven to be wrong. I think the key point is really to focus on what's potentially ahead of us from big picture perspective, but also from bottom up perspective. So the big picture stuff, rates obviously looking like peaking, economy slowing down, but I think to some extent the markets probably factored some of that into prices already, and you see that in retail stocks, which is always the first to go. But really from a bottom perspective, and that's where we're sitting right at this minute, at the cusp of reporting season. So there are several things we're looking out into the next few weeks, which will help us determine what the next 12 months could look like. And I'm probably on the optimistic side rather than the pessimistic side at this point, Pete.
Yeah. So if we put together the critically important issues of, as you've mentioned already, interest rates topping out, Wall Street looks like it's going to give a positive lead to our market. I'm thinking that a lot of companies that haven't done well in the US because of interest rates, when interest rates have topped out, they'll start being, re-loved again, if you like. So I see momentum coming from Wall Street. And also corporate earnings in the US have been better than expected. Are these all going to be tailwinds that will at least help our market, going towards the end of 2023 and then maybe rolling into 2024?
Sure. Let me give you two perhaps negative points to start off, and I'll focus on the positive on the
sure.
question. The key negatives is that we really focus on balance sheets of companies right at this moment. And the reason we're saying that is because interest rates, as we know, have risen So we concern the companies with high debt levels, and that will crimp the abilities of these companies to keep a high dividend payout, to investors or shareholders. So there's probably some of the negatives, which we think probably hasn't been factored into the market at this point, because most investors focus on the top line revenue growth, but very little on the bottom line, or rather on balance sheet. So that's one point of concern. And secondly, we just don't really know how volumes are going to stack up into the next 12 months, or rather demand, because a lot of companies have increased prices the last 12, 18 months. So we think that some of that might stick, but we're not sure of how demand will stick around in the next 12 months. So we're probably a little bit concerned about that. And therefore, commentary-wise, qualitatively, I think we're quite downbeat. But I think when we look out next, 12, 24 months, there will be a number of companies which we think are looking, in my view, well positioned. And retail is really on the pointy end of negative or pessimism at this minute. But when we look out next 2-3 years, there will be companies which will be, coming out of this soft period in a stronger position. And here you might have heard me talk about companies such as JB Hi-Fi, where I think management's top grade. They don't have an issue with balance sheets. Sales are soft at the moment, and I expect management from JB Hi-Fi to continue to comment that soft sales are going to be still soft. But I think when we look out 2-3 years time, companies JB Hi-Fi will actually do quite well. So there's a real split identity in the market. On one hand, the defensive companies such as Woolies have done really, really well this year, but they're already trading on very high multiples. So Woolies trading on 24 times. And on the flip side, you've got JB Hi-Fi at about 12 to 13 times earnings. So real divergence in prospects, I think.
Yeah, very attractive, JB Hi-Fi. All right, so that's one. I totally agree with you. What else do you like that fits in that category of great company, out of favour now, but in 1 or 2 years' time, the market will be, going back to them?
Yeah, look, let me raise the issue of Macquarie Group, Pete. Reported earnings, first quarter earnings, that is, just a couple of days ago, end of last week. Came in soft, 8% below market expectations. And that's because, the number of one-offs from the previous year, which is impacting the baseline for Macquarie Group rather. So the market's probably a little bit undecided what to do with Macquarie Group. Share price didn't really fall a lot, say about 3% against earnings downgrade 8%. So it's held up really well. Again, this one where I think, when we look out the next 12, 18, 24 months, it's one which will probably do quite well in my view. Fundamentals remain unchanged from my perspective, especially when you think if interest rates are going to come off, say, start of 2024, I think a group like Macquarie Group will benefit from both fundamental growth in its core business, but also a cyclical side. So capital markets will probably improve into 2024, and the likes of that probably will be a tailwind for the group into next calendar year, in my view.
Yeah, and if the US economy starts to rebound in 2024 with maybe either no interest rate rises or even maybe a cut or two, Macquarie is bound to be a beneficiary, isn't it? 'Cause it makes a fair bit of money out of the US financial system, doesn't it?
Absolutely. So yeah, so I think when capital markets improve, the US market's by far the largest market, right? So you see Macquarie Group benefit out of that prospect. But today, Macquarie Group is really diverse. A lot of investments into green energy or green investments. That's a durable trend, in my view, a structural growth trend. But also increasingly, it has a large exposure to funds management on a global basis. So as markets improve, I think the prospects of Macquarie Group should improve as well on that front.
At the moment, you're talking about quality businesses that are currently not doing all that well in the market. How does CSL fit into your view of its
Yeah.
future?
That's an interesting one, Pete. Yeah, look, Macquarie, CSL had a rebasing, so to speak, of its earnings for 2024, FY24, just last month, which was unexpected. I think the market obviously got in ahead of itself where its recovery is concerned, from 20% growth down to about mid-teens kind of growth for 2024. That was the rebase. So as such, the share price did come back quite a fair bit. I think it looks good. In my view, the recovery for CSL's earnings is really driven by demand coming back, costs looking to improve into the medium term. That's probably one which I think I'm quite positive on the medium term. I think investors by and large are waiting for the results to get an opportunity to get a sense of how conservative perhaps management might have been before making a decision how CSL might trade into the next 6 to 9 months. But if you're looking beyond the next 6 to 9 months, I think CSL looks really well positioned. The key takeaway from its peers in the US reporting through the last couple of weeks does indicate that donor fees, which is a key cost, has actually been coming off. And that's, I think, is a positive for the industry itself, not just CSL's peers, but it should also affect CSL positively from a cost perspective. And the impact here is that the margin should rise in the next 2 to 3 years.
Yeah. Okay, so CSL. Any other companies that you like that sort of fit into that quality basket that currently are not being loved by the market?
Yeah, two companies, Pete. Depending which angle you come from, not all of them may be quality, but I'll just raise them anyway. Yeah. Credit Corp, which is a debt collecting agency, ticker CCP, reporting its earnings tomorrow. It is one which is really leveraged to developments in the US market because that's where a lot of the growth is coming through. And I suspect we might get some update from Credit Corp into its earnings tomorrow. And really the key thesis is as the US economy kind of softened, but really is a Goldilocks situation for debt collectors. What I mean by that is that as long as employment keeps up, individuals are probably more likely to pay off their debts than not. Yeah. Right. So as a debt collector, it's probably somewhat of a Goldilocks scenario for guys like Credit Corp. The other company which I'm looking at very closely is Breville, ticker code BRG. Small appliances, coffee machines, pizza makers, for example, stuff like that. Again, the US consumer, which is a large consumer of Breville appliances, has stayed up much stronger than expected. So should the economy in the US hold up, then demand for small appliances could actually do quite well. But really the key kicker for Breville is expansion into the European market, which is going to drive its revenue growth in the next 3 to 5 years. And that's really the upward kicker where Breville is concerned. Yeah,
I recently looked at Breville and the analysts are pretty well on side with you on that one. ST Wong, always great to talk to you, mate. And I hope you're right for most of your predictions.
Thanks, Pete.
That's ST Wong from a fund manager called Prime Value. And that's the show for tonight. Thanks for joining us. Remember, this is purely for Switzer Report members. If you've got friends and family who would like to invest as well as you, make sure you tell them about the Switzer Report at switzerreport.com.au. Thanks for joining me. Talk to you on Monday, or if you turn up to the Boom Doom Zoom show on Thursday, I'll see you then.